It's accounting fundamentals and DC Adler. Watch how it all works together. Topic of the video is what goes under each of these accounts. Quick recap. We know that there's 5 main accounts. Accounts are like a filing cabinet. Top drawer, second drawer, third drawer from the top, fourth drawer, bottom drawer. What's the title of those drawers? Account number 1 is assets. Account number 2 is liabilities. Account number 3 is equity. We take equity and drawer and merge those together for the concept of getting from 6 placeholders in DC Adler to 5 main accounts. Number 1, number 2, number 3, drawer and equity go together. Number 4 is revenue. Number 5, expenses. Then the question is, well, what constitutes an asset and what constitutes a liability? What goes under each account? If I was to open the asset drawer in the filing cabinet, that's the top drawer, what sort of things do I find inside there? If I was to open the liabilities drawer, drawer number 2, what sort of things am I going to find inside that filing cabinet drawer with a label of liabilities on the outside? Well, good news is class packet to the rescue. So there's a class packet. Class packet looks like this. There's a table of contents. Inside the table of contents, it gives us everything we need to know, outline where to find it in the class packet. If we go to the section about accounts, there's a summary page, and it's represented in a couple of different ways where you'll see it's going to look like this. Here's a list of sub-accounts that live in the accounts filing cabinet, the assets account. Here's some examples. The liabilities account, here's some examples. So if we think about assets, assets are things that create future economic value, future economic gain for a business. And it says in the packet that assets are things like cash. If we have cash, we can get future value out of it. If we had land or buildings, we could get future value out of it. If we have equipment, we could get future value out of it. If we have inventory, we could get future value out of that inventory by selling it. These are all assets. These are all what would fit the sub-accounts within the asset drawer in the filing cabinet. And there's a little bit of funky accounting language called accounts receivable. Accounts receivable, which is typically referenced as uppercase AR, accounts receivable, meaning that's money that somebody owes us. We're due to receive that money into our account. And once I've received that money, I could make future economic value out of it. So accounts receivable live here under assets. And I'm just pulling this straight from the class packet. When we talk about liabilities, right? Liabilities is we're liable to pay somebody some money. So liabilities create future economic sacrifice. I've got to deal with that at some time and pay that liability. Liabilities has an accounting term that goes with it called accounts payable, or uppercase AP. AP, accounts payable. I'm liable to pay somebody something. Accounts payable, that AP term will come back to us later on. Wages payable, loans payable, interest payable. What do those words have in common, those terms? They typically, liabilities typically have the word payable associated with them. Payroll taxes or taxes payable. I have to pay those out. And unearned revenue is listed as a liability in the class packet. Unearned revenue, that's a whole separate video. We'll unpack that. It's basically revenue that I haven't earned yet. Somebody gave me an advance on the money. Let's say it was for a catering event. They said, here's the $1,000 upfront for the catering, and I haven't done the work to earn that revenue yet. But they know that I'll deliver the food for them within a week. That unearned revenue, it was money coming in, but I haven't done the hard work to give them that. I still owe them the food, is why that's going to be listed under the liability column. Equity, account number 3, what goes under each account? Under equity, it says input from owners. If Luca's Lemonade, Luca is the owner of the lemonade truck, and Luca puts their own money in to help float and support the business, then that's called dollar input from the owners, and that is going to live as what goes under each account. What goes under the equity is dollars invested into the business by the owner. And there's another piece of accounting language that lives under that column in the packet called retained earnings. So at the end of money coming in, money coming in, money coming in, I got to pay all my bills, money going out, money going out, money going out. At the end of the accounting period, whether the period is a month or a quarter or a year, when I close out that accounting period, thank you, Luca Pacioli, any money that's left over gets stored in this equity account. And it's called retained earnings, pulling from the class packet, where it says that's the earnings that are retained or left over the business stay in that equity account. Under revenue, 1, 2, 3, 4, we're always going to follow this structure around here. Under revenue, well, that's we sell, we make sales, we get revenue. We sell merchandise, we get revenue, right? That's coming in. We get providing services. Let's say as part of Luca's lemonade truck, we're typically selling food and beverage and selling merchandise. Typically our revenue stream in the Luca's lemonade truck example is going to be from sales of food, sales of beverages, or sales of merchandise. If it was a service business, if Luca, instead of a lemonade truck, had a carpet cleaning business, then Luca provides the carpet cleaning service and the revenue comes in that way. Under expenses, 1, 2, 3, 4, 5 in the DC ADE LER structure, expenses are the things that we have to spend money on in order to keep our business running. So if you look in the class packet, it says rent. It makes sense that we've got to spend money on rent to be able to generate income as revenue. Utilities, we need the cost of gas, we need the cost of water. Our utilities, we need to spend that money in order to make money. The cost of a phone service, the cost of an internet service, marketing, the money we spend on marketing Luca's lemonade, that's going to be an expense because it's something we need to spend in order to get the business running and to keep it running and to get the revenue coming in. Licensing fees, we got to have a license, to a food service license to be able to sell our Luca's lemonade food or beverage products. That's an expense in order to operate the business. So in accounts, there's 5 main accounts. Number 1, 2, 3, 4, 5. DC ADE LER captures that beautifully for us. And those 5 accounts, we draw to equity. That takes us from 6 placeholders in the DC ADE LER structure to get to 5 accounts. The answer now to what goes under each account, if it's land, building, cash, and so on, like it says in the packet, it goes under asset. If it's a liability, something that's payable, it goes under the liability. It's going to be filed under the liabilities drawer in the filing cabinet. If it's equity, it's the dollar coming in from the owner, or it's retained earnings, the leftover money that didn't have a place to go, gets stored right here. If it's revenue from sales, revenue from whether those sales are food or whether they're from beverage or whether they're from merchandise or providing a service, it goes into the revenue drawer, and the bottom drawer is the expenses. The expenses are the things we need to spend money on in order to make the business run. Then it goes right here. So what goes under each account? It's right there. And it's also in the class packet, and we should go back into that class packet to help see the relationship between the words on the paper and the conversation that's going on right here. And at this point,